Right. Of course, we're not turning out to be a great Friday morning after six straight day of gains. But from a longer term perspective, how is the setup looking like? What are the, next set of headwinds for our markets? And, how should one really navigate and what kind of expectations one should have from uh, the market in terms of returns for this year? Let me bring on board our guest for today. Joining me is Nikhil Khandelwal, Managing Director at Systematix Group. Nikhil, lovely chatting with you. Welcome to Money Control. I think this is the first time I'm interacting with you on our show. But just want to get in your sense on where we are headed from here. There's been a spate of good news domestically. Of course, globally we have quite a few headwinds to deal with. But domestically, there's been the GST reform. There's been an S&P upgrade as well. uh, are we poised to make a dash at fresh highs, given the fact that we've seen a very good rally coming in the last week or so?
Hi, good morning. Thanks for having me on the show. Yeah, I think the last 1 year has been quite volatile for markets. We have seen that, we defined the last year as, a broader slowdown in economic momentum, or what we saw across government capex slowing down, the tariff situations over the past few months, and especially over the past 3 weeks or so, has not been supportive to India's exports, as well as even on the domestic front, the banking as well as the non-banking sector, there has been broader slowdown in credit activity. As a result of which, over the past 12 months, we have seen that the capital markets have relatively been flat. In fact, except for the last 1 week of market uptick, the market cap erosion has been to the tune of almost 30 trillion rupees, which is close to about 15% of household income. So from a market perspective, I think except for the last 1 week of gains, the market has been quite flat. However, the markets as they are, they start to look at things which are in present and in future. So definitely there are a lot of winds of change, whether from a domestic consumption boost, whether from a rural economy picking up, as well as government's increased focus on domesticating a lot of industries, and focusing on made in India and make in India. So combination of that, there are several green shoots which we are beginning to see, and I think that is beginning to reflect in the markets. We also are of the view that with all the correction which has happened over the past 12 months or so, the markets valuations are now below pre-COVID levels. So in the entire setting, when we see where the valuations are, it starts to become quite interesting from a long-term investor point of view.
Sure. Of course, you mentioned the valuation point, but we've seen FII community pull out a sizable amount from the Indian markets. Given the fact that we are better placed in terms of growth, compared to the EM peers, although market returns wise, we haven't really been able to outperform them this year. But would you expect FIs to return anytime soon, or would you say that they are still uncomfortable with the valuations we are commanding?
No, I think the FII flows are something which we believe remain, in a 2 years of strong inflows, 1 year of weak inflows. It's a trend which they follow, and it
Hmm.
happens with kind of the global economic macroeconomic situation, with India actually being the most tariffed economy in the world. It's very obvious that some of the large foreign investors will sit on the sidelines for the time being. So as the tariff situation starts to kind of play out, maybe kind of cools off,
Hmm.
and I believe even the Indian economy, the domestic market growth, and the earnings growth momentum starts to improve. With those things kind of playing out, the FII flow should begin to come in. Having said that, I think the domestic flows in India, we are seeing that they have doubled over the past 2 years. The monthly SIP numbers are as strong as ever. the number of alternate investment funds putting long-term money into Indian capital markets is increased by almost 3x in the past 12 months. So a lot of that data, which is from domestic investor point of view and domestic capital point of view, flowing into markets is quite heartening. So the
Hmm.
FIIs will trickle in, but the domestic capital should continue the markets and the flow is quite strong.
Sure, since we are talking about domestic flows in equity markets and etc., let me get in your thoughts on the big talking point right now. SEBI will come out with a discussion paper on longer tenure for FNO derivatives. Of course, the likes of BSC, discount brokers, they are staring at revenue hit, because of volume loss. So, how would you approach these names now? And within the capital market theme, do you think it's a golden opportunity for AMCs, that end of the capital market theme?
No, actually, the SEBI has been talking about this whole derivatives market point for a while. I mean, as the data goes, as many of you may be aware, India is just about 4% of the global market cap, but accounts for almost 60% of global equity derivatives volumes. And as SEBI has been throwing the data about the retail investors making significant losses, sometimes some number like 45,000 crores in the last financial year. So SEBI has been worried about it. They've been clamping on many instruments. They've been limiting contract expiries. They have raised lot sizes, and hence the cost of trading in options over the past few quarters. So this move, of course, which can lead to potential taking off of weekly expiries. That can be quite an impact on the overall derivative volumes. To answer your point, the for discount brokers, I believe the data goes that about 80 to 85% of their revenues come from derivative contracts or derivative trades. And a large part of derivative trades which happen in India is in the weeklies. While SEBI clamping down on weeklies might lead to people shifting to fortnight and monthly contracts, but there will be a sizable impact on the volumes which happen in the discount brokers. So definitely they will be more impacted than the regular wealth focused brokers or I'll say the more brick and mortar players. On the exchange front as well, we believe that BSC as an exchange garners a larger volume or larger part of their revenue from FNO trades, and hence
Hmm.
BSC may be impacted more than NSE. Although for both the exchanges, the revenue from derivatives is close to about 50% or so. So definitely there would be an impact on the revenue and profitability of the exchanges, but more on the discount brokers. The
Hmm.
details of the SEBI paper, etc., is of course yet to be seen, but most likely based on our market chatter, it is moving in the direction where weekly expiries may be taken off.
Sure, of course, evolving, and we'll be watching out for the discussion paper as well when it comes out. But let's talk about sectors now. Consumption, of course, that's the big theme now. We've had tax cuts in the budget. We've had RBI rate cuts, of course, now with the GST rate rejig, and we have the eighth pay commission as well around the corner, right? Do you expect consumption to pick up meaningfully? And do you think consumption-centric names are poised for a very strong second half? Also, what do you really like within this universe? It's a very broad universe. So, what are your preferences also in the consumption space?
Well, we have been quite positive on the rural theme in general over the past couple of quarters or so. We were seeing that the government capex in infrastructure was going down, but government, incentives and benefits which they provide to the rural households, that has been, trickling down quite well. Fortunately, the monsoon situation has been quite strong, as well as the general gold financing, etc., actually also helps the rural household. So combination of that, we have seen that the rural market has been showing strong volume growth. This started to show in Q4 and in Q1 as well. So we continue to remain quite strong on the rural theme. GST, the announcement by the Prime Minister on 15th of August about GST rate rationalization. Again, while that is a big hit to the exchequer in terms of their revenue loss, but it is a broader positive for the consumption economy. We believe this GST rationalization and the details of which are already coming in will have the
Hmm.
biggest impact on Indian consumer economy than any other tax announcement which has been done by the government in the recent past. So definitely the consumption economy, especially the packaged foods, the more affordable housing, the affordable retail, those themes start to become now extremely critical. For us, the rural as well as the consumption market starts to look extremely promising from not just a little to medium term, but even from long term. Uh, from our perspective, the government's GST reduction to 5% on packaged foods, etc., is likely to give a positive boost not just to large companies like Nestle, HUL, etc., but even to
Hmm.
the smaller beverages names, even dairy companies like Dodla, Varun Beverages, etc. The auto
Sure.
sector will see a significant positive of especially on companies which manufacture two-wheelers or small cars like Maruti or Hero, but also to the farm-dependent automotive companies like Mahindra and Eicher. So it's actually having a broader impact on the consumer economy.
Hmm.
And so yeah, I mean, lot of positives for the consumption pack as a large. So we
Sure.
remain positive on agri and consumption for that reason.
Right, but I can see that you are also structurally positive on capital goods. And, data centers is another end that you really like as a long-term theme. Can you explain the rationale here? Because the government focus seems to be shifting now more towards consumption from capex.
No, if you see, India actually has been one of the fastest growing markets in terms of moving to alternate energy. So from that point of view, India has taken the lead, I'll say, in the past 5 years, as far as investment in creating the right infrastructure, the right incentive for the alternate energy market. While which is actually quite visible in our wind as well as the solar energy sector growth. So if you see any of the large players in this sector, whether it's the Suzlon or the Inox in the wind side, or the Varis and the Premier Energies on the solar side, that has actually seen strong growth momentum. The entire ecosystem of the power evacuation is also has been a big focus for the government. So we are seeing a significant capex happening on evacuation of power, which is extremely critical as your power needs of the country grows. So we remain quite positive on the larger power sector because the overall investment in power evacuation as well as power generation and diversification of power has been done in a very methodical manner over the last 5 years. Significant backward capacities have been created in this sector. So, and the power need of the Indian consumer is growing as we move towards, more technology intensive power needs like data center. That power needs are going to spiral even for further. So, overall, the power sector, which comprises of the power producers, the evacuators, like the transmission and distribution companies, as well as the equipment manufacturers, which are the transformers, reactors, etc. All the people in the chain will benefit significantly. We hence remain positive on that. India is also one of the few countries which is extremely focused on ensuring that the data which is of the Indian consumers data remains within the country. So they are
Hmm.
asking some of the larger overseas e-retailers also. I'm sorry. to ensure that all of the data of the Indian consumer stays within India. So that is leading to a significant investment in data centers capacities in India, not just by the
Hmm.
global biggies like the Googles and Amazons, but even the Indian companies. So as a result of that, our belief is that the data centers industry and the cloud infrastructure industry in India will grow significantly. There aren't many companies in the listed universe who focus on this as a big focus area. So we will see a
Hmm.
lot of new companies which will now come to the market for through new listings. But L&T has invested in this company called E2E Networks. There is a company called Anantraj, which is actually investing
Yeah.
a significant amount of capital on data centers. So combination of these and many more which will come to the market will fuel a lot of action in the data center in the coming years.
All right. Just a few more questions then, Nikhil. Tell us, we've had a fairly subdued earnings season, this first quarter. But looking at the commentary, looking at the outlook from companies, which are the pockets that you would advise investors to avoid at the current juncture?
Um, well, the um, in our view, the government capex will be something which will remain a mixed bag. The government
Hmm.
capex on infrastructure, as a loss to the exchequer because of the GST impact. As I mentioned, about 50 to 60,000 crores of revenue loss will be there to the two states and center combined just because of this development. Uh, the infrastructure related investment areas like roads, water, some of these areas may take a little bit of a hit. In our view, companies which are significantly dependent on state funding for roads and water, those sectors should be avoided at this point of time. The luxury retail segment also is something where we believe that the theme has played out quite well. And
Hmm.
while Indians are, always looking to invest more in their luxurious spend, we believe that growth in that luxury retail category will be something which will be subdued over the next couple of years. So luxury retail, as well as the infrastructure sector for us will be something which we will avoid for at this point of time. While this US situation on tariffs, etc., remains a little bit of a challenge, this is, in our view, going to impact our textile sector numbers in the
Hmm.
medium term. So, textile sector also, we believe, for the next couple of quarters will throw a little numbers on the negative side. So, textile sector also is a larger negative for to us for the near term.
Sure. Okay. Those are all the pockets that one should avoid at the current juncture. But talking about systematics per se, yours is of course a listed company. Just want to understand how are you guys also placed in terms of growth and margins going forward?
Well, Systematics, we primarily operate in businesses focused on institutional and HNI clients. We run a brokerage, investment bank, wealth, and asset management business. We operate in a business where our largest cost is people and technology. Last year we generated a revenue of close to about 170 crores on a profit of about 60 crores. And we are growing our asset management and wealth management business at quite a rapid pace. From our viewpoint, we have been a 35% CAGR business over the past 4 years, with an ROE, ROC in excess of 20. And we expect to continue to grow that way.
Hmm. All right. And you guys are also coming out with an MSME focused fund. Can you give us some more details about that as well?
Yeah, as a house, we have been a company which has been focused on working with medium and small enterprises on whether on research on their investment advisory, or even in terms of our investment mandates. We believe that MSMEs are a backbone of economy. They generate maximum employment and are actually generating a significant amount of innovation in the country. As a result of that, we have just launched a very unique AIF Category 1 fund, which is going to focus on investing in medium and small enterprises, which are at a late stage of their growth and are likely to
Hmm.
go public in the next 3 to 6 months or up to a year. So it's like a pre-IPO fund, but focused on MSMEs,
Hmm.
which is a very unique category in itself. So quite excited about that. We are just closing that fund in the next couple of weeks, and hopefully you hear some developments on investments from us from next month onwards.
All right, point taken. Of course, that's a new fund that's coming out of the Systematics Group. But lastly, just 5 more months to go for the year to end. Have you made any changes to your return expectations for the market? It hasn't been like any other year, and expectations are far muted. But would you at least see a high single-digit return for the Nifty, given the fact that we've had a spate of reforms and the government really, pushing the pedal when it comes to reforms? How would you look at how we are poised to end the year?
No, I think as Indians, we are ever optimists, but most importantly, I believe, the consumption side of economy is what drives India, what world sees as India, and what world needs to see India as is our Indian consumption and our Indian consumers. As we get more strong, starting from rural and all the way to the middle and higher middle class, which is happening through a lot of the factors which we discussed.
Hmm.
As those data start to play out, and I think that overall consumption boost happens very close to all this festive season. I believe the next 6 months in particular will be quite strong for the Indian economy as a large.
Sure.
And we
Point
should
taken,
see
Nikhil.
in our view probably 5 to 7% gains in the index as on
Hmm.
March 26.
Okay, taking your point, 5 to 7% kind of return from the index by the end of FY26. But with that, Nikhil, would like to thank you for taking out time and sharing your thoughts and perspective with us. Appreciate your taking out time, and I look forward to more conversations as well in the future.
Thank you. Thank you. Pleasure. Thank you.
Thank you. Thanks a lot. Well, on that note, let's take a look at what the markets are doing. We are where we were at when I last did a check on where the markets were. It's down 120. Below that 25,000 mark, 24,960 is where we are at. But the mid cap index is